Want to start investing? First, you should know that investing is like a marathon that will build wealth over time. Not a huge amount of money is required for having a high return investment. Experts believe that average people could become rich by purchasing assets regularly over time. But how? Stay until the end to learn how dollar cost averaging can benefit you. Imagine that you inherit a considerable amount of money, or maybe even win the lottery. What would you do with your money? Would you dump all of that into the stock market, or would you chuck it up into a smaller amount and invest in certain areas over time?
So dollar cost averaging, absolutely yes.
Does dollar cost averaging help you to gain larger profits? Let's know first what a dollar averaging strategy even is. If you want to explain it as simply as possible, dollar cost averaging is the strategy of spreading out your stock and fund purchases over time so as to decrease the effects of volatility. So, whenever you're trying to use this strategy, it should be best to buy the stocks at a regular interval and in roughly equal amounts so as to gain a significant benefit for your portfolio. Dollar cost averaging means that instead of waiting for the perfect moment so as to buy a lump sum, you could just put in a certain amount on a regular basis. It does require investing in stocks on a flexible schedule, maybe every week or every other month. Let's assume that you have an IRA that you contribute to every week. The money is then taken right out of your bank account and automatically invested in an S&P 500 fund. For example, you're already taking advantage of this investing strategy by making purchases of the fund with a fixed dollar amount on a fixed schedule, even as the prices of the S&P 500 go up and down.
S&P algorithm is very hard to beat. In a diversified portfolio of big companies, it's all but impossible for most people.
When you want to be able to use this strategy, you shouldn't care about the market fluctuations, as its ups and downs and everything else is related to the price of the S&P 500 shares. Your money will remain there when you retire, and the good thing about the dollar cost savings is that it allows investors to be able to profit from market dips by purchasing more shares whenever the prices are low. Many investors, especially those under the influence of social media and stock price changes, end up getting nervous when they see the prices are getting lower and lower. This is when they sell their shares day by day, and that's the biggest mistake. The time interval in this strategy can be days, weeks, or even months. For instance, let's say that you wanted to get into Bitcoin. Instead of looking at the price and letting your emotions decide your decisions, you instead do agree to yourself that you'll put in $100 each month now. Of course, some months might be higher, some might be lower, but beating your emotions is exactly what the dollar cost averaging method is trying to achieve.
Now, if you buy something like Bitcoin or some cryptocurrency, you don't have anything that's producing anything. You're just hoping the next guy pays more.
To be able to have a better understanding of how dollar cost averaging can make you profits, we should compare it to other possible buying strategies. For example, investing $100 in the same stock every week, 1 week, the stock prices might be at $10, which means that you can buy 10 shares. The following week, the stock could be at $20, meaning you can only purchase 5 shares. This would allow you to be able to benefit from sales opportunities and purchase 20 shares. So, the number of shares that you will be able to buy highly depends upon the stock price ups and downs in the investment time. In this way, market fluctuation won't only affect your investment, even when the economy collapses. Many investors are frightened and stressed and are willing to sell whatever they have. Then, whenever the market turns and finally recovers, these people gain confidence once again and start contributing to these accounts. However, most of the profit has already been made by this time.
All right, so this is getting out of control. First, we had Facebook plummet 26% in a single day. Then we had Netflix fall 35% overnight as they lost subscribers. Shortly after, Walmart drops 25% on missed earnings.
The problem with these small investors is that they quickly get impacted by news headlines and, of course, the market volatility. They panic and see their shares at the worst time ever. Whenever you decide to employ a dollar cost averaging strategy over a period of time, your emotions should be left entirely out of the game. This method is excellent for new investors who might still be a little bit confused. If you are a new investor and you want to add your position, imagine that you have $100,000. Which option is more reasonable for you? investing the entire sum in the stock market on a single day, or buy $10,000 worth of shares over a few months. As it is impossible to forecast what will happen in markets, investing money over time sounds like a less risky option. Investors, even the experts, cannot predict the market's ups and downs. These experts also might have totally different ideas about one stock price at the same time. Generally speaking, dollar cost averaging has three key advantages leading to better returns. 1, it avoids misestimating the market. 2, it takes emotions left out of the investing process. And 3, it gives high returns over long terms. It keeps investors away from making psychological biases and emotional decisions, as investing naturally deals with fear and greed that are prone to making wrong decisions. The dollar cost averaging method has nothing to do with fear, because the time price drop, all investors are getting fearful and selling their shares. So you should buy more shares at a nice price to be able to gain long-term benefits. The most thoughtful way of this is to invest and have a plan. Many investors rely on their emotions at the time that they either buy or sell, but in reality, the best investors have plans. Let's check out this example to show you how dollar cost averaging can help you at lower and higher prices. Imagine investors who deposit $1,000 monthly into a stock. In January, with $1,000, he can buy 50 shares. In February, he can purchase 62.5, by March, 83.3, and in April, with a certain amount of money, he can buy 58.2 shares, and eventually by May, it'll hit 43.48 shares. As you can see, in just a couple of months, actually only 5 months, the investor owns 298 shares. $5,000 that have been spent on buying those shares has now turned into $6,857. Now imagine that the same investor spent his entire money at once at any given time during those 5 months. The total price might be higher or lower. However, the important thing here is that by employing the dollar cost saving average, the investor lowers his risk of investment as much as possible. Suppose that the investor purchases all of the shares in one day. In that case, he might have been lucky to buy the shares at the dip, but also could have not been lucky and he ended up buying shares at the all-time high, giving him limited returns.
To make sure you're going to do some kind of, like, spread it out over 4 years, do it every quarter, something like that, 5 years. And that's a conservative idea.
Dollar cost averaging has a few simple steps that you need to follow if you're interested in starting an investment. First of all, you need to decide on the amount of money that you want to invest. Choose an amount that fits perfectly with your financial situation. Then, it would be best if you determined how often you wish to invest. It can be daily, weekly, monthly, or any interval that is proper for you. As the last step, you should decide the dollar amount invested at each interval, so that way you can divide the amount by several periods if it's a lump sum. But if it is an indefinite investment schedule, budget how much that you can reliably afford. You can always keep in mind that you should stick with your program whenever you use this method, no matter whether the price goes up or down, or what markets do on a particular day, week, or month. If you end up deciding to spend $100 every week or every month, just stick to your goal no matter what happens. Once you pick a date, commit yourself to start on it and go for it. Don't be fooled by thinking you can limit losses by selling your investments whenever you believe the market is heading down. But instead, keep investing the same dollar amount regularly, enjoy low-price investments, and purchase fewer shares to the same dollar amount whenever the assets are more expensive. Buying stocks can be very tricky and stressful. You may purchase stock too soon and regret it if the price drops. It's also possible that you wait for lower prices and the price goes up and makes you feel like you missed out on an excellent opportunity to become rich. Dollar cost averaging is intended to reduce these risks in the stock market and helps you to make your position little by little over time. Like other investment strategies, dollar cost averaging doesn't fit every person's situation, but it is a reliable tool for eliminating some risks and emotional barriers to investing.